following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, it's time once again for Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network, upon which many of you are listening to this program right now. And I would encourage all of you to play along with us as you're listening to the show. Surf on over to theoptionsinsider.com. You can find more information about all the topics we're discussing on the program today, as well as, of course, archived episodes of Volatility Views. You can catch up on all the shows that you've missed. And perhaps most importantly, you can also use our comment system to shoot us a question for the show, or you can just shoot us an email, questions@theoptionsinsider.com, or find us on Twitter or Facebook. A lot of ways to get in touch here with the old Volatility Views program. And joining me on the Volatility Views panel are my partners in crime from the realm of volatility, starting off with the man holding down the fort over there at optionpit.com. He is none other than Mr. Mark Sebastian. Mark, welcome to the program, sir.
Hey! Hey!
I'm glad to see that the Fonz has joined us today. Well, apparently you're as excited as I am to be on Vol Views today, so that's good.
I'm always excited to be on Vol Views because that means I get time with the master, the most brilliant trader I think I've ever met in my life, the Swami of selling.
Stop it! You're embarrassing me.
Oh, shucks. I'm looking around the room.
The hierarchy of historical volatility. The regal realized volatility master. The vixen of vol.
I'm looking around the room, and all I see is me, so something must be wrong.
Listeners, that voice also, of course, belongs to good old Don Schlesinger from the Volatility Exchange. Don, how are you doing today, sir?
Everything good, and another day where the market is on the rise, and we see a contraction yet again in VIX futures, and all of the negatively correlated products. So I'm sure that Mark will have some interesting observations because we had ticked up for a couple of days, but we're right back down in those doldrums that he and I have been talking about for several weeks now.
That's quite the lead-in, Don. You have a lot to live up to on the show today, so we'll see if you can accomplish that Herculean task. Of course, we'll also be joined a little bit later by our special guest for this week. He is Mark Shepard, the founder of Derivative Strategy Consultants. So stay tuned for that interview. But before we do that, we're going to roll right into our Volatility Review segment.
It's time for the Volatility Review.
All right, and welcome to our Volatility Review segment. This is, of course, where we look back on the week's worth of volatility action. And there wasn't a heck of a lot of vol action. We had the slow bid up going into the earlier part of the week, and I think a lot of people speculated, including on some of our other shows, that that was indeed attributable to the non-farms. We're recording this right now, dear listener, at the middle of the day here on Friday in Chicago, Friday the 1st of February. So we're right after the non-farm number has come out, and of course, with the number out, the most of the major indices are rallying about 1%, and VIX is coming off aggressively. The VIX cash down about almost 10.5%, almost 11% on the day today, or about 1.5 handles to 12.77. So all of that premium that had built up rolling into non-farms now coming out, and we won't get into the future a little bit because that'll ruin our crystal ball segment, so we'll save that, Mark. But just looking back on the week's worth of action, what do you make of this kind of slow ramp up and then just chopping off at the knees of the VIX cash here?
Oh, you could see it coming from a mile away. I've been talking about this all week. You know, we saw a run up ahead of the ISM / non-farms, and then it just right out again. We're up about 1% in the market right now, and this could be the most exciting day of the entire month.
I had a feeling you were going to say that.
You know, this is just sold. This vol is just so, I mean, it's still insanely expensive. You know what 20-day real, I'm sure Don is going to tell us. You know what 20-day realized volatility is in the S&P 500 right now, Mark?
Well, given historical precedent, I'm going to say about 5%.
You are dead on, 5.5%.
There you go.
That's 20 days. That's an entire month of trading. It's nothing. And so we knew that when the number came in line that the VIX was going to fall. Now we're filming this at about an hour and 45 minutes to the close. I'm expecting it to see another half point come out. Do not be shocked. I think we could see an 11 handle next week. And that would still be too expensive.
Mark Sebastian stepping all over the crystal ball yet again, but it's kind of hard to do, kind of hard to avoid in these markets, in these midwinter summer doldrums that we are indeed experiencing right now.
In the deep midwinter.
You didn't know we had a musical component, did you, dear listener?
Yeah.
So that was for your listening pleasure and or terror. I'll leave that up to your personal taste. It's going to be haunting my dreams for quite a while, though. I know that. Don, let's quickly segue away from that. Don, what is your take on the week's worth of volatility action here from a NASDAQ and, let's say, other vol perspective?
I just want to clear up one thing. I'll cross-reference it with Mark to see if it in fact is the case. We quote on our websites both historical volatility, realized volatility, and we also have forecast volatility. And I'm showing what we call the 21-day historical volatility as about 10.33. Now, what we do there is that's actually 30 calendar days and 21 trading days.
Well,
21 actual
Don, you and I have a
days.
very, very, very important difference in the number we're quoting.
Right.
Yours is 21 days, mine is 20. Tomorrow, when you and I, if we look at the exact same stats, we will be much, 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 much closer. You've got a day that we moved 30 some odd handles in yours. I do not.
Okay, I just wanted to make sure that in fact, when you say 20 days, that's still 20 trading days worth of
Yes.
data. Okay, fine. So Mark brings up an important point. Anytime you look at moving averages, you also have to realize that the farthest date gets thrown out each day and the near date replaces it. So if you have something in an average on the back end, which is a very atypical and unusual day, such as the one that Mark has just mentioned, you can have a very different perspective, and you have to be careful in quoting the data, because as one data point falls out and a more normal one replaces it, occasionally that can have a very big impact on the averages. In any event, both S&P and NASDAQ realized volatility are down considerably, even from our show of last week, and numbers that were 15.5 and 12.2 for NASDAQ and S&P respectively are now down in the 13 handle and 10.3 per S&P, and as Mark mentions, likely to be even substantially lower as previous data points drop out. So again, for people who are looking at VIX and saying, how low can it go? Well, consider what typical spreads are of implied volatility to realized. Consider that realized are at single-digit numbers that we haven't seen for a very, very long time, and that it's quite possible that VIX will go even lower still, despite the fact that a lot of people have not seen numbers like this even in their own trading experience. But if you're a little bit older and you go back as far as I do, I think I can remember the end of 1994 in the S&P when we were looking at about 4.75 as 21-day realized volatility for the index. So this is low. It's not unprecedented, and you have to realize that we're in a different regime now, which Mark and I have been trying to tell listeners for a long time. People keep on saying, this can't last, and they've been saying it for months now.
Don, don't be modest. You go back to the gaslight era of the VIX and the SPX. So don't sell yourself short there is what I'm trying to say.
Well, I do go back to the era when Mark Whaley was in the what's his first name? Whaley from I'm saying so many Marks and everything, but Robert Whaley. Robert Whaley actually stood in front of our group, and we were co-sponsoring a conference with the Fuqua School of Business at Duke, and said, we have this new idea for an index, and we're going to call it VIX, et cetera, et cetera. So I think I was kind of there for the founding days of when he was running this by various audiences, talking about what they were planning to do. And I actually think that was back around the same time in 1994.
Yes, the early gaslight days of the VIX. And you're right, this is an important discussion to have today because we hit on it a little bit last week. But when it comes to vol and pretty much anything trading related, it's just like the realm of physics. It's all about frame of reference. It depends on where you're standing and what you're actually looking at. Two people could be looking at two very similar things from a very different angle and seeing two very different results as a result of that. So interesting stuff. I know a lot of you listeners out there who wrote in asking for some vol updates, some vol reviews on some other products like commodities and futures options. We're working on that and bringing that into some future shows. So stay tuned for that. But now we're going to roll right into a very interesting discussion in our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to our Volatility Viewpoint segment. And I don't know about you, Don, but I love that little theme. It always gets me charged up to keep going with the show here. And we have a great guest for you today, joining us via the magic of the telephone. Always amazing to see how the technology continues to evolve. He is Mark Shepard, the founder of DSC Derivatives Strategy Consultants. Mark, welcome to the program.
Hey, thanks so much, Mark. I appreciate your time. I appreciate the audience, and looking forward to talking with you and Don about the volatility and what's going on in the markets.
And Mark, since this is your first time on the program, as we are wont to do with all of our first-timers here, why don't you take a couple of seconds to introduce yourself to the audience, give them a little bit of an overview of your background in the options and derivatives markets.
Surely. Thank you. I've spent 18 years in the financial markets. I started on the floor of the SIBO here in Chicago back in 1995 as a clerk. Then in 1996, I was an independent market maker on the floor, traded in the Kmart McDonald's pit, and traded there until 2002, until I went upstairs and started trading more electronically, and traded equities, indexes, and futures as more of a proprietary trader, of course focusing on spread trading and volatility. And then in 2008, I joined a commodity trading advisor here in Chicago that had 400 million AUM, had various strategies based around the S&P 500, and I was primarily their long volatility and tail risk portfolio manager. I also traded a risk-reward multi-asset class futures option strategy for a fund-of-fund in London. And most recently, I started Derivative Strategy Consultants. I've been at it for a year now, and I've had a lot of help, a lot of fantastic camaraderie with our options insider people and Options Alliance that you founded. And it's been a pleasure to work with clients and bringing my knowledge to education, to consulting, and to outsource derivative strategy for those clients.
Now, Mark, you've since transferred over to the dark side of consulting, but we won't hold that against you here on the program. not by a long shot. But actually, I think what you're doing over there is quite interesting. One of the reasons why we wanted to bring you on the show, of course, is because I know you work a lot these days with the institutional clientele and their desire for structured products. It seems like that audience, that market, just can't get enough of these types of products. So why don't you tell our listeners a little bit about what types of structured products, particularly in the volatility realm, that they're looking at, and how they like to hedge their exposure to the broad indices, to the broad market, using these types of structured products?
Well, it's a great question, and each client is different, of course, and that's part of where the education of these products, especially with what Don and the Vol Exchange are trying to do with their products, you have to get in and be able to communicate and clearly talk about the portfolios. And what will happen is I'll identify certain aspects of a portfolio where they either need to add return or to possibly hedge a product. Most recently, with the VIX coming down 30% over the past couple of weeks, I've personally felt that it's been a great time to look out at the volatility skew and curve to take advantage of maybe some pricing levels 5 to 6 months down the road. But what we'll do is we might buy a specific VIX future and then look at the macro issues such as oil, such as gold. Where are we going with this inflationary or easy printing policy that the Fed has? And then I'll take a look, obviously, at let's go to the futures options contract in oil, or the volatility, the gold volatility index, and take a look to see if we can't find some inexpensive options to take advantage of those inflationary policies. And then we'll put a package together, say one specific VIX option versus one oil option versus one gold option, and put that in a package, same time frame, and try and make that as feasible as possible for the client.
So you're talking about more of a bespoke type structured product rather than some of these off-the-shelf levered ETF and other types of structured products that are floating around the volatility realm. You're really doing a one-off construction for each individual client.
Yes, that's a great point. I don't think that each client of mine is necessarily going to be similar to the other. However, there really are some great ETF and niche products out there, and it really depends whether I am going to trade the product for the client or whether I'm going to work with their investment consultant to give them a little bit of advice as to how to trade the derivative product based around that.
And I guess it would also seem, because I did a little of this when I was at Morgan Stanley, that if the client comes with any type of holding or portfolio that closely enough resembles an already existing product and the correlation is close enough, you may be able to work with the listed. But if they come with something that's rather unique or custom or tailor-made that really needs something considerably more over-the-counter, that you're going to then come up with your own structured product and overlay that to their portfolio.
Yes, Don, you're absolutely right. And that's part of the process of what DSC does, is getting in front of the client, taking a look at their portfolios, taking a look at their positions, and more times than not, coming to DSC, these clients do not already have optionality in their portfolios. So even when I'm looking at their positions and talking about whether we can add derivative contracts, I of course always have to make sure that that the derivative products are the best for their portfolios. If there is an ETF that would be more suited, then I would certainly suggest that.
Right, makes sense.
And Mark, I'm assuming since you're out there constructing these custom structured products for your clients that you probably take a dim view of a lot of these other more off-the-shelf type products that are floating around out there these days, particularly in the volatility realm and in the options realm. Let's say replicating a protective put and, of course, charging you a 5% fee for the privilege, or maybe replicating a 2x volatility product or something along those lines. These products that have been causing a lot of, let's say, end-of-day volatility in a lot of these products like VIX, but otherwise don't seem to really offer a lot of the customized features that you're talking about. I'm assuming you tend to take probably a dim view of those types of, let's say, a plain vanilla one-size-meets-all products versus these relatively unique things that you're talking about.
Yeah, I think that possibly for some clients who don't have the experience that may be an interesting caveat for them to look at or to introduce into their portfolios. But being an active subject matter expert, I'd like to think that being able to look into the derivative markets and being able to advise the clients first and foremost that my experience would portend to be much better than a one-off product, as you say.
Now, Mark, let's talk about that a little bit because we're recording in a very interesting environment. At the moment we're recording, we're post non-farm payrolls here today on a Friday in Chicago. Of course, volatility in the mainstream concept has been beaten. The drum has been beaten to death that volatility is low. Volatility is low. Of course, we've discussed on the show many times how realized versus implied. There's quite a differential there, and there really is no realized vol to speak of right now. A lot of that seems to be contributing to the dramatic sell-off in the volatility and VIX we're seeing right now. The VIX cash selling off over 10% today post non-farm payroll. So let me ask you, in this environment that we're in right now, let's say a client comes to you, say I have a broad market portfolio, I want to hedge my downside risk. Or what are you counseling them right now? What kind of product are you structuring for them? Are you taking advantage of these, while not overall low, comparatively low levels of volatility to put on some tail risk protection? Are you taking some other approach to that? And also, I think on the flip side of that, has this environment of relatively low volatility, has that caused an uptick in your business? Are the clients aware of that? Are they coming to you saying, hey, this is a great time to hedge my volatility risk right now? Or are they completely unaware of that? So start off maybe with the first one, and then we'll get to the second question.
Sure, I think that can be answered twofold, obviously. Well, I just, on DerivativeStrategyConsultants.com, I just posted a blog that talked about that specific issue. And I think for not only myself, but for my clients, every day I have to think about what's going on in the S&P and then take that away from what I see out in the economy with 7.9% unemployment, with just a great deal of political dysfunction, and then seeing the S&P 500 and the Dow Jones near all-time highs. Obviously, corporate earnings and balance sheets have been fantastic thus far, but we have to take a different approach. And right now, with the VIX at 1275 or whatnot, I think that now is the time, certainly going out with the consumer confidence going down, with oil approaching $100, with political tensions, with Korea and Iran and elsewhere in the Middle East, there could be some pretty serious dislocations in the market. And I think now is the time, if not going full force, now is the time to at least start your active hedging approach, whether that would be going out and buying a VIX future or finding something on the vol exchange that I'm sure Don is going to talk about, or if you had a broad portfolio, then looking at the S&P 500 and putting on some type of inexpensive collar strategy. along those lines. I think those are some fantastic ideas that talking with clients, that those are easily communicable. Those are very easily modeled, and that visually I can show them to the client, and that they'll understand the process going forward. Then if they would like something a little more specific, then that can be adjusted accordingly.
And I guess the flip side of that question, the second part of that then, are there any clients you're finding in this environment who are coming to you who are already cognizant of that and saying, hey, I know volatility is on the downward end of its spectrum here, and I think this might be a good time to perhaps hedge my risk, and can you do that for me? Or is that just a pipe dream and the clients are still blissfully ignorant of most of this stuff?
Well, that's a great question. I come across that every day. I know that clients look at their 401ks every month, and there hasn't been much traction in the past 10 years. And they're just wondering when they should go back in the market full force. And really they're just looking for someone just to tell them the truth, what's going on. You know, I think that Wall Street has really given a black eye to a great deal of our to our industry, the people, you know, the Options Alliance and all the folks out there who are really trying to run their businesses. You need to be able to get out there and talk with the mom and pops to make sure that they understand that you're in their corner. And I really think that talking with them and being able to communicate the education process as well as how you're going to trade the product for them is absolutely essential, and that's a great deal of my business.
You know, Mark, it's interesting what some of the comments you just made resonated with me a little bit, because we talk quite a bit on this show about looking to the future and looking where there are any potential sources of vol, and a lot of us here have kind of been scratching our heads lately. VIX has been in the doldrums for a while. We've essentially been calling this period the midwinter summer doldrums. We had a little bit of some implied vol lurking in there because people were assuming there might be another economic debate coming up in Washington in the end of February, beginning of March. They seem to have settled or tabled most of that discussion, so that premium came off. We saw VIX kind of bidding up a little bit ahead of non-farms. That, of course, all of that premium has come off. So we've kind of been scratching our heads lately to say, hey, where in near term are we going to see any sort of really sources of perhaps realized vol to generate some fuel for the market here? It sounds like you think there might be, actually, with the Middle East and some other areas, you think there might be some very near term sources of vol to kind of juice the market back up again.
Yeah, absolutely. You know, if you look at the VIX historically at these levels, I think you can never time the market, and whether it's in futures or options, there's a limited time frame. But that's why I suggest to clients at least put a little bit of hedge on when you can. Don't wait till when you have to. And then it depends obviously on the specific products and the portfolio and the risk that you're willing to take. So I would go in accordance with that philosophy.
Mark, I have a question only because I kind of did this for a living for a while, and sometimes it was rather challenging. When we spoke before about a client coming with a portfolio or holdings that don't mimic so well a listed index or have available listed products that you could propose as a hedge. And when you then have to go out and custom make a particular option, whether it be a put for protection or whatever the client needs, and you then sell that as an over-the-counter derivative product to the client, what's your own ability to hedge on your side and to integrate this into your own portfolio that you may have? Because now you're short that particular product. Let's say it's a put, and you either have to go to the listed market and look for something close or actually trade the underlying stocks, which gets rather messy. So without giving away any proprietary secrets, I was just wondering if you have your own trading desk and you know, your own people looking at these things and how you manage to handle that kind of exposure.
Sure, that's a great question, John. I appreciate your experience and the question as well. The specifically for what I do on the consulting realm is I will advise the clients, and I will work with either their broker, their prime broker, their FA, or whomever to execute those trades. So I won't necessarily take the other side of that trade. And I think one of the best parts about what DSC does is that I'm actively involved in the product. I don't take the other side, which is what a lot of Wall Street firms did for so long. And I think you've heard a lot of the news stories come out about certain firms taking the other sides of the bet from their clients. And then when the clients get burned, then how do some of these firms make all these hundreds, millions, billions of dollars? So specifically for DSC, and to your question, what I'll do is go into a client's office, institutional client's office, and model specific ideas and strategies I have, and then work with their investment consultant to put these strategies in place to see if they would work on a holistic approach.
So then if they themselves go to seek a particular product at your recommendation, where, as you say, you're not the person on the other side of the trade, do you also provide advice as to, shall we say, advisability of accepting offers from potentially these investment banks that you mentioned, and price levels and suitability and things of that nature?
Sure. As of right now, I have not necessarily had to go to a high-level investment bank, as you say, to offlay a specific strategy. However, I would be interested in hearing your views, and certainly about if I did come to the Vol Exchange with some ideas about how I could implement specific customer queries with what you're doing.
Well, it's interesting. I was saying it in the context of the advice that you provide, but eventually, and hopefully sooner rather than later, the Volatility Exchange will provide listed products. So no need to have to custom make if what fits into the client's needs would actually be a rather pure volatility product, somewhat different from VIX or from a sentiment product in terms of implied volatility, but one where a client is actually in search of trading what might even be considered a separate asset class, as many people now consider realized or actual volatility. And whether it be on the indexes or on fixed income or various commodities, we're hoping to come out with an entire suite of products that would actually deliver as a futures contract the realized volatility of the underlying asset over some time frame, whether it be 1 month or 3 months or even longer dated out, a full year. So in that case, they would actually have access to trading actual market volatility as delivered by, the classic standard deviation formula that would allow them to overlay that, if need be, onto a portfolio and trade that particular asset. And then, of course, there would be spread possibilities. You're familiar with VIX, and you know that it has a very strong negative correlation to equity price movement, so that when the index goes up strongly as it does, as it is today, we see VIX decline, and vice versa. On the down days, you see VIX and the futures start to pop up. Well, that's not always the case with a realized volatility product, because there you have movement regardless of direction. And on a day such as today, you might actually see a realized volatility product tick up if it's in its calculation period, and if today's movement actually is one of the data points input into the model, just as much contribution to the upside as the downside. So there are spread possibilities there, where if you were bullish on the market, you might want to own a realized volatility contract and sell a VIX contract, so that if the market goes up, you actually can make on both sides. Realized volatility is on the rise, but implied is likely to be dropping as the market is rising.
Of course, I certainly appreciate the those views, and it sounds like you want me to start a hedge fund. That sounds great. I'd love that. I just need some more capital.
Well, since we can't
absolutely well done.
Products, since we can't trade products, maybe you will.
Oh, that's great. Actually, one of the questions I had with an institutional client is they are starting to look at how to move very large positions out of the fixed income market and possibly go into equities and possibly go into some alternative investments. So I certainly think in part of the communication and education process, why I use derivatives and being in the field for so long is that you can actually show them the time frame. It's a time contract, and you said 3 months, 6 months, 1 year. Then if I can offlay some of that risk for some clients on the fixed income side while they adjust to a different asset class, different sector, or whatever, then that is an absolutely influential and fantastic product, of course.
Well, Mark, a couple more questions here before we have to roll on with our show. But first off, earlier you mentioned helping your clients to hedge their risk and talking to them about the value of putting on some of those hedges and actually buying premium to hedge in this environment when things are comparatively cheap. I hate to use that word, but comparatively. But, notorious, these clients in this space are infamous, somewhat notorious for wanting to hedge everything but not wanting to pay a nickel worth of premium to do it. It's a problem a lot of advisors, a lot of managers in this space, a lot of consultants really encounter when they deal with these clients in this space. So as you're having these conversations with these clients, telling them about the advantages of hedging their volatility risk in this marketplace and hedging their exposure to the underlying, how do you overcome that reluctance? I know you discussed collars in the past. Do you find yourself having to really resort to all types of these types of trades where you have to spread off all or most of the premium, perhaps even more than you're comfortable with, doing ratio downside put spreads or leaning heavily on the upside part of the collar to really offset enough of that premium to make it palatable to the client? Are you finding that clients now in this environment are perhaps a little bit more willing to shell out and actually pay and put some money on the line to actually get some real protection?
Sure, it's a great question. First and foremost, when talking with clients, I'll say, well, how well did your funds do in 2008 and 2009? And then that reminds them very quickly that, yes, these moments do happen, and a lot of the pensions and most of the pensions cannot financially take a hit like that again. So when they understand that and they see the market at all-time highs, then it becomes very easy to take a basis point or two or three to provide significant downside protection. Even if you're capping a little bit of upside, then generally I can talk with them and model, an S&P P&L graph or something with Live Vol is one of the systems that I use, and for them to visually see that, then that really starts to make a difference. And I think that when I talk with them, they want to be able to go back to the people that work at the companies on their pension boards and say, yes, we can guarantee that if the market moves in dramatic fashions like it did in 2008, 2009, then we at least do have some hedging in place, and we won't lose 30+%. And I think that is just a tremendous fact for these people who work so hard to be able to go back to their own folks and tell them about what they've done.
Well, I'm glad to hear that, because you think with 2008 and 2009 in the books, you couldn't have a better argument in favor of what you're doing and of hedging in general. And yet if that hasn't opened their eyes to this, then really what is it going to take? I know a lot of people in your space tend to love the zero-cost collar. It's become the tool du jour for a lot of people in your profession because it just overcomes a lot of those arguments, even though at the end of the day it's not the ideal tool a lot of them would like to lean on. It just overcomes a lot of that premium debate you have to have with the client on a regular basis. So if you can find a way to have your clients actually pay for some quality protection, then I think you've succeeded at your realm. But yeah, one last thing, then we have to roll on. This has been an ongoing question, a discussion topic for us here on the program for a while. Everyone, it seems, in the options and the derivatives markets in general is fixated on the realm you're kind of working in right now, the advisor / asset manager / institutional realm, where traditionally penetration for options and things like we're talking about, hedging strategies, things like that, has been very small. A lot of people are spending a lot of money to go after this market because it is so untapped from an options / derivatives potential. But I think a lot of those people really might be tilting at windmills at the end of the day, because it seems like there's a fixed percentage of people who will get this product category and use it, and the rest are kind of perhaps lost to us to some degree. So do you agree with that? Do you think that the future of that space that you're operating in right now is really, rather than all these people who are thinking there's going to be a massive migration of advisors and asset managers into the options market, rather than that, the future is really going to look like more like what you're doing right now, which is experienced consultants like yourself taking the word to the masses, as it were, and kind of doing that for them on a bespoke basis and handling a lot of that through a sub-advisor or other type of arrangement?
Sure, absolutely. Certainly I think that derivative strategy consultants is probably one of the first people to get out there and to talk with the institutional, the foundations, the endowments, and the pensions, and to really try and be a subject matter expert and work with their internal investment consultants. There are very few, with all due respect, very few investment consultants that have folks who have hedge fund or CTA experience in the options and futures side. So really what DSC does is go in as a subject matter expert and helps quantify what they're trying to do. Sometimes it works, sometimes it doesn't, but when it does work, then the client is absolutely satisfied. Their portfolios are well maintained, and that's what it's all about.
Well, Mark, I'm glad we could have you join us on the program today. That's about all the time we have, but we have maybe a few more seconds really quickly at the end here just to say, if you have anything you want to leave our listeners with, any thoughts, any ideas, any overall thoughts on the realm of volatility right now, this is your chance.
Okay. I think the greatest question that people are asking is, with the Federal Reserve printing money as actively as they are, then what is that going to bring to our future, and how does that relate to specific volatility in the S&P and other investments? And as we all know, tail risk events always happen when you don't expect them to. So I don't know if necessarily something's going to happen in the S&P 500 or the credit markets or the debt markets, but I think now certainly is the time to use derivative strategies to at least start the hedging process and be able to take some alpha out of the market as well.
All right, Mark, glad you could join us on the program today, and we'll perhaps have to circle back with you down the road to see how some of these strategies are being implemented in the vol realm, and of course look at some other interesting endeavors going on in the structured product realm.
Love to. Thank you so much, Don. I appreciated the conversation and learning more about the vol exchange, and look forward to hearing more about your products down the road.
Well, thanks very much for coming on. It was a fascinating half hour or so. You're welcome back at any time, and we appreciate your sharing your views with our listeners.
Oh, and I should mention for I should mention for our listeners before you go that if they want to learn more about what Mark is doing, or perhaps contact him to discuss some hedging or structured product needs, and you can surf on over to derivativestrategyconsultants.com. Pretty easy to find. So there you go. You can find Mark over there at the DSC website.
Thanks a lot. Have a great day.
All right, and that's going to do it for our Volatility Viewpoint segment. And now we're going to roll into our final segment, our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and that melancholy music means it's time for our final segment, the Crystal Ball segment, the portion of the show where we peer, or perhaps attempt to peer, into the murky realm of the future and attempt to determine what lies in store for us from a volatility perspective. And we somewhat teased it at the top of the show, but if you weren't there, you might be scratching your heads. Maybe you skipped to this part, who knows? But if you missed the opening volatility review segment, you may be curious to what we think about what's coming up. Of course, we hit on it in recent shows as well, only half jokingly referring to this period as the midwinter summer doldrums. The non-farms now taking what's left of the gas out of the market. It is a bit of a head scratcher as to what will really juice this market with some volatility going forward. But perhaps Mr. Sebastian is aware of something that I am not. Mr. Sebastian, what do you foresee for the realm of volatility and VIX for the coming week?
You know, it's going to be the same old, sell the index, buy the stock. And that's where you'll find your win. Your index vol all week is going to be too high. There will be stocks, even Don can admit to this, there will be stocks where the volatility is too low. So if you're looking to have relatively low gamma exposure, that would be the way I would do it.
So you're talking about sell SPX and buy a broad Google or something
Google.
like that. Yeah.
Google, I selling SPX, buying Google, and maybe Apple, and maybe some currency. Where I'm seeing a little vol is actually in the currency sector, currencies, and in a little bit of the precious metals. That's really about it. Maybe oil.
Yes, SLV being one of the few bastions of volatility in this market right now, and metals in general. Gold perhaps being a bit of a laggard, but overall metals once again becoming a refuge for those searching for a little bit of vol in this
Well, maybe my
marketplace.
band, the Mini Metals, will be back.
Yes, the Mini Metals.
We'll have to go get them.
They've been on hiatus for quite a while, listeners.
They really have.
Perhaps they'll be returning.
Metals in a long
Perhaps
time.
they'll be returning to a venue near you soon. Check the schedule on optionpit.com for the performance schedule, upcoming performances of the Mini Metals. I guarantee you, if they are playing near you, you don't want to miss them. You've never seen a precious metal themed mini Kiss cover band in your life. It's really something to behold. All right. And of course, Mark Sebastian being their manager / guru. And Don, moving away, segue us away from that again, please, sir. Bring us back to reality. What are you looking at for the road ahead and the week ahead from a NASDAQ and, let's say, other vol perspective?
I can't disagree with Mark. The market looks like it has some pretty good momentum at the time being. There are some technical thresholds that if we push through are going to go to rather higher resistance levels, and we know with the negative correlation that if the markets do continue to rise, it is very likely, despite the low levels, as I said earlier, that VIX, in fact, will continue to decline. Little bit less certain as to what might happen to actual or realized volatility, because if we continue to have some really big days and up movement that is not just steady but rather sharp, a day such as today, we could actually see some upticks in actual volatility. But this is a time where, as Mark said, if you're looking to get your volatility fix, you may just have to look at individual names and do a little stock picking, if you will, and try to go with those that have the potential to have some rather large movement, because in my view, index volatility is most likely to continue to decrease for a while.
I'm going to go out on a big limb here, Don. All right. I'm going to say today, right now, the S&Ps are up about 15. The NASDAQ is up about 33. Okay? And I'm going to say that today is going to be one of the two biggest realized volatility days of the entire month of February.
And realize what's interesting in a statement like that, if you're correct, is that all we do have today, 15 points on a 1500 index, is a 1% move.
That's right.
S&P. And so when you annualize that, that's 16% for the day. And what you're saying is that's going to actually represent one of the biggest, if not the biggest, moves of the year. And that only of the month. And that only translates to, 16% volatility. So think about what the other days are going to be and what kind of volatility that equates to. And you very well may be in the single digits again.
That's exactly right.
So, Don, to translate things into your favorite binomial indicator, the sell or don't sell, I'm guessing you're leaning towards the sell side of the fence from an implied vol perspective right now.
That's what it looks like to me.
So for all our listeners who love the sell or don't sell, there you go. You have your binomial recommendation for the week. We'll check back in next week to see if that changes, I'm guessing. Given if everything plays out as we expect, perhaps not, but you never know. Maybe there'll be a surprise thrown into the works there next week.
The one caveat and the reason that I've been very, very reticent to make any predictions at all too extensively on implied volatility is my somewhat, uncomfortable stance of trying to predict what other people are going to predict. All the handwriting on the wall could be to rising markets and decreased volatility days, such as Mark has said. And, options traders may get scared for one reason or other and predict higher levels. And it may not have any basis in reality. They may push up implieds and create a huge spread over actual realized volatility. And, I can't stop them from doing that. So I always feel a little uncomfortable predicting not a number that you can calculate or a number that's formula driven, but rather a sentiment number and how options traders are going to be thinking. And it's not a cop-out. It's just my discomfort with the whole concept of trying to predict what other people are going to fear or feel, over the next week or a few weeks.
That's just your backhanded way of saying implied vol traders are all wackos, right, Don?
Well, let's say it's my backhand way of saying that it's not my favorite product to trade with a great deal of confidence.
Well, coming soon, perhaps, to a trading venue near you will be a much easier chance to trade actual realized vol. We won't have to mess around with all this implied nonsense. There we go, Don. All right. And that is going to do it for the Crystal Ball segment. And unfortunately, that's all the time we have for this episode of Volatility Views. But before we wrap up, I always like to check in with my cohorts here, my partners in crime on the old Vol Views panel, to see what they have in store for you in their respective necks of the woods. Starting off with you, Mr. Sebastian, what do you have in store over at OptionPit.com? I think my little birdies have informed me that you may have a webinar on the horizon.
Yeah, I'm going to be doing a webinar with your boy Mike Tusaw on Thursday. I'm going to be discussing using the VIX as a trading indicator. Should be a fun one.
Well, somewhat relevant for this audience then. So
it is somewhat relevant for this audience.
If you're listening to this show and want to check that out, you can surf on over the Options Insider. We'll actually have a link.
I'm going to explain that vol should almost always be bought and that it's really predictive. And that usually option traders are dead on.
And you'll be hearing Don just screaming in your mind in the background while you're doing that entire show.
I hope somebody didn't just tune in to the last minute of the show.
That was a joke, folks.
If you want to know more about that, and you could surf on over to Mark's site. He might have a link to it in his event section. I think we'll also be linking to it next week on the Options Insider, so stay tuned for that link, or just surf on over to the RCM. I believe it stands for Reliance Capital Management website. Should have a link to it there as well. So a lot of places to sign up for that webinar. I think a lot of our listeners may be interested in that. And last but certainly not least, Don, what is coming up over in the land of Volex.us and just at Volex in general?
Well, a quiet week in terms of the website, but, I've been teasing our listeners for so long that they probably wonder if there's any basis to it. But we're really, really, really close now to putting the finishing touches on a term sheet with a major force in the investment community and with a partnership with Volex. So we do hope to have an announcement out during the month to come, and we'll furnish more details as the time goes by.
You keep teasing us, Don. One of these days, we're going to have to turn our backs on you, sir. So hopefully that will come soon before our audience says, enough of the teases. We can't take it anymore.
I don't want to ever work in the legal department of any of these big institutions, because let me tell you something. It is the most tedious, complex concept you ever want to go through, and it really can try your patience sometimes.
Indeed. The legal department is certainly not my purview, which is why I like to stay on fun shows like this. And of course, I want to remind all of our listeners out there, if they want to join us on the program, we're going to have a great mailbag segment coming up next week. So if you want to get your voice heard on that show, now's the time to do it. Surf on over to theoptionsinsider.com. You can leave us a comment on the site that we can pull into the show. You can shoot us an email via our comment form and use that to let your voice be heard on the show. Of course, you can just shoot us an email directly, questions@theoptionsinsider.com. Just be sure to put the subject line, the name of the show, in this case, Volatility Views, or you can find us on Twitter or on Facebook. A lot of ways to reach out to us and make your voices heard on this program. A lot of you have been doing that, so we certainly appreciate all of you who are taking the time to join the show. We love to hear what you guys have to say. After all, that's what the whole show is about. It's about doing it for you guys. If we want to just hear ourselves talk, we'd sit in a room and chat with each other, and we certainly do that quite a bit, but we like to do it for you guys once in a while as well. So be sure to let your voices be heard on the Volatility Views program. And of course, all of us on the Volatility Views program want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.